Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Welcome back to Financial Strategies Radio with Daniel and Andrew Agemy from Agemy Financial Strategies. People don't know what people don't know. Do you want to know? Well, that's what today's show is about. And we are talking about today something that's so simple, it's almost embarrassing as it explains what growth actually means and why most retirees are chasing the wrong kind. Today's show, known growth versus unknown growth. The income secret retirees seldom learn. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. AAA, what is growth? That is kind of embarrassing because people throw that term around all the time, and it means very different things to different people.
Right.
An investment advisor, a wealth manager, a financial advisor thinks of it as one way. Retirees think about it as another way.
Yeah.
And different age brackets think of it different ways. Like right now, growth to a lot of people means you just put it all on the line. You can lose it all, but if you win big. And
right.
It's funny how it changes over time. It changes from generation to generation, but it also changes based upon what industry you're in or what type of person you are.
You know, the English language is so funny, Daniel, right? You know, like for, the Greek language, my understanding of the Greek language for the word love, we have one word, love, but the Greeks, in the Greek, at least ancient Greek, was 4 different meanings to that word and 4 different words to describe the different types of love, right? Because there's different types of love. And so that's where I'm always big on making sure the definitions are in line. Like yesterday, somebody came in my office for the first time, meeting them face to face. And I said to them, my goal today is make sure that we're on the same page with definitions, that the words I'm using, either I'm using your definitions to the words, or if I'm using my definitions, that you agree with my definitions. And one thing is the word conservative. What I find is most retirees agree that conservative means not losing principal, making as much money as you can, but not losing any principal. But like you said, a financial advisor and within the industry, their definition of conservative is usually other than that. And so same thing with growth. On the other end, conservative is the one end, but on the other end, you might say is the growth end, you might say. And what is the definition and how does this come about, right? It's funny, right? Because people sometimes say, all I want to see is my bottom line growing, being bigger than it was before. So some people and that's usually what most people mean by when they're talking about growth. Right. But then
that's usually what people mean, but that's not usually what people say. Right.
Right. Yeah.
And that's a good point, AAA, because that's what they mean. And they say growth. And then their money manager or their advisor says, oh, growth, that means share go up. In order for me to get share go up, that also means share can go down. And that's not what the person was thinking when they said growth. They were thinking exactly what you said. Exactly what you said. I want to see my bottom line go up, and I don't want to lose a lot, right?
Right. They want to see consistency of the bottom line increasing. They don't like the inconsistency of it changing and going backwards, turning into a loss. Because like you say, when a financial advisor thinks of growth, he realizes, well, there could be loss, but it will come back again to growth. But that's where today's show, known growth versus unknown growth, is so key. Because usually, what you just described, what most financial advisors describe, financial people describe as growth is unknown. Because we don't know if today it's going to be up or it's going to be down. But retirees, they always want to see it up basically every day, at least not down, right? And not backwards. They want to see it the same or forward every day, right? So
yeah, and that's typically the thing. The psychology changes, AAA. The psychology changes big time when you have a 40% drawdown on a $40,000 account or a $25,000 account compared to a 40% drawdown, meaning markets decide they're going to sell off that week, that month, that year for things that are out of your control on $1 million portfolio, because it really hurts if you're close to retirement, right? And you have a 30-40% drawdown and your account goes from $1 million to $700,000 or $600,000. That completely changes your retirement. You may not be able to retire at that point.
Right, exactly, Daniel. And so that's where our stress test that we use on investments of people, right? When somebody comes to see us and they want us to do a financial MRI, free second opinion, and RRR, we do a stress test on their investments. And that's what's so beautiful about that stress test, because the stress test looks backward and says, well, what would happen to these investments if we had another 2008? What would happen to these investments if we had another financial crisis? What would happen to these investments if we had another growth in the market like we did in 2013? And it's such a beautiful thing, Daniel, because people come in. Yesterday, I had somebody else come into the office that I did a stress test on, and they had said to me their definition of drawdown on their money was no more than like 12%. So on $1 million, you're right, they don't want to see it come down below like 880, that's a lot of money.
Yeah.
If you're talking in dollars, right? If you have $1 million, right?
Yeah.
Well, that's what they said. That was their definition. Well, guess how their investments were set up? If we had another financial crisis, their investments would come down to $600,000 or $1 million.
Wow.
I said, you're off, man. Your investments are not set up the way that according to your definition. And they didn't like that. So they wanted to make a change. So, but my point, why I'm saying all that is for you and our listening audience. I'm going to go out on a limb here. I have not done this before, but you're listening to Financial Strategies with Andrew Daniel Agemy. And today, for those who are listening to our show, we're glad to do a stress test on your existing investments to show you how they would perform if we had another run up like in 2013, or we had another financial crisis, or we had another 2008. You need to know so that you can make a informed, smart decision. Is that how you want it to react? Or do you want it to react in a knowing fashion that you don't have to guess and hope it's going to grow, but you know that it's going to grow? Today's show is called Known Growth versus Unknown Growth. The income secret retirees seldom learn, and we want to give it to you today. If you want that stress test, call us at 800-725-7616, 800-725-7616. Robin will help you to be able to speak and get that stress test taken care of. 800-725-7616 to know what condition your assets would be if we had another 2008 or financial crisis, or even have a growth spurt. You listen to Financial Strategies, known growth versus unknown growth. So Daniel, as usual, we're burning through this stuff, right? But I like your analogy when you're talking about growth, right? Different ways of getting growth. Right. So go through that analogy for us.
Well, AAA, we're talking about known growth versus unknown growth. And as we said at the beginning of this show, everybody throws around the word growth, but would you like to know if you're going to have growth, or do you want unknown? You don't know if it's going to happen. And typically the people we talk to say, well, obviously I would want known growth. But the difficulty is most people are not set up as the example you gave a little bit earlier. So an analogy you could use to explain the difference between known growth and unknown growth would be an elevator. So you get to the tall building and you say, hey man, I got to get up to the penthouse in that building. So you walk over and you see an escalator and you say, I think that might take too long. Let me hop in the elevator. So you get in the elevator, you close the doors, and you could shoot up 25% of the way there, you could drop down 50% into the basement. You know what the problem is? You're not pushing the buttons. You found out after you got into the elevator that the Federal Reserve is pushing the buttons and quant funds are pushing the buttons and big managers are putting the buttons and hedge funds are pushing the buttons. But you know who's not pushing the button? You. And so you watch the flashing buttons go up and down as you're trying to get to the place you want to go, but you have no control over it.
Or it's like, that's much like, how have you ever gotten into an elevator on a big thing like that and found out that somebody got out and pushed all the buttons? Right. Yeah. That's another thing. Just right.
Not in control. And it's frustrating and there's nothing you can do. And you sink to the bottom and you feel the sink in your gut as it sinks down. And then you say, well, what do I do now? Do I try to make it back up? Do I start over? Do I sell at the bottom and go get on the escalator? What do I do now? Right. That would be an example of the unknown growth. You don't know. Right. Am I going up? Am I going down? Do I I get one floor away and I don't get out and it drops all the way down to the bottom. The other is the escalator. And it may seem slower, but what's the difference? You get on it and it moves up and you can see around you. You can see what's happening around you. You see the environment around you. Yes, it may go slower than the elevator just going straight up, but you never get drops on escalators. You never get that gut-wrenching feeling in your stomach because the elevator dropped too quick, right?
Right.
And it goes up consistently, step. And if you want to move faster, you could start walking on the escalator too. Right. But you don't have to. You can just sit back, chill out, and let it take you up to the top while you watch the views around you. That's the difference that we're talking about here between known growth and unknown growth.
Yeah, and that's the difference, and there's stress with the unknown when you get on the elevator, especially when you get on the other elevator and find out that all the buttons have been pushed and you're 10 minutes late already for your appointment, right? As opposed to the escalator that methodically is going to get there. And, the other analogy I think of, Daniel, when you said that was, when I'm on the road and I'm going to maybe the New York airport and I'm one of the New York airports and I need to, and I'm kind of like in a hurry and I get on and I see, it's stop and go traffic. I would rather get off and take one of the side roads that are just going to be, I'm going to move. It may be longer, more miles. It may take more time, but I feel a lot better about it and less stressed because I'm always moving, which is better than to stop and go and, going at pressing the gas, going forward, stopping on the brakes and getting seasick and, having to throw up.
It's dangerous. Yeah.
Right. And much less stressful. If you want to invest, if you want your life to be stress-free, invest for the I rather than the G. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is known growth versus unknown growth. The income secret retirees seldom learn. We're glad to have you on the show today. We have a paper that we like to give to you. This is called G equals I plus CA. G is growth equals I income plus CA, capital appreciation. The truth about growing your money for retirement. We love to put this in your hand because it's going to help you see things from a new light. It's going to help you to know the secret that retirees seldom learn. And we want you to learn today because people don't know what people don't know. We want you to know what you don't know by receiving this paper for free. No obligation. Call us at 800-725-7616. 800-725-7616 for your free copy. Call now.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you. So you can enjoy your retirement. It's a little more income stability.
I'm in.
That's 2 out of 3.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
What does growth actually mean? What does the word growth, when it comes to your retirement portfolio, mean to you or to your a financial professional, or what does it mean? Let's dissect that word. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about known growth versus unknown growth. And AAA, there is a big difference on the way you invest, where you can say, I know how much is going to come into my account, versus we're hoping for the best. We're doing a Hail Mary here, and we're hoping for the best.
Right. There's a huge difference. And, it's scary. The unknown is scary. That's one of the reasons why retirement is, when people get to the top of that retirement mountain, as I call it, it's scary because everything is changing. Their paycheck is changing, their schedule is changing, their friends are changing, everything is changing. And sometimes with that, there's grief because working for 40 years and this huge change brings grief with it, because something is dying, albeit for a better life, for something hopefully better. But, we ended up the first segment of the show giving away that paper on G equals I plus CA, which is growth equals income plus capital appreciation. But that's where we need to be able to know how to get growth. And that's the secret that retirees seldom learn, is knowing how to get growth. They think they know what they know. They think they know how to get growth. But how people got growth when they were 20, 30, 40, even 50 years old is different when they're in and close to retirement.
Yeah, AAA, we talked about the elevator versus the escalator, right? And we talked about one is unknown what's happening. You're not pushing the buttons. Somebody else is pushing the buttons. You're not in control. And the other is you get to ride up. It may be a little bit slower, but it's consistent, and you get to see the view. You get to enjoy it while it's happening.
Yeah.
Folks listening, which ride are you interested in? And to break that down a little bit more, AAA, when people say, I want growth, they want to see their account value go up over time. And a lot of times what professional advisors, investors hear is, I want to see stocks grow. And there's not stocks that only go up, right, AAA?
Right.
It depends. It depends what's happening on the economy. It depends what's happening on those companies' earnings. They can be very fickle. It depends what's happening with investor sentiment. It depends what happening the Fed is saying. It depends on quarter-to-quarter earnings. Now, you could pull a Warren Buffett and just close your eyes and ride it all through the whole way. But Warren Buffett doesn't need any of his money. And that's where it makes a big difference, is if this money is just, I'm going to pass this on, it's in a trust and nobody's ever going to use it, or this is an institution and no one's ever going to need it, or what's the purpose of your money? Is this money so that I can retire? Is this money so I can live the 30, 40 years I have left in pure enjoyment and not have to go back to work? Is this so I can fund the vacations we want to do early on in retirement while we still have tons of energy and we want to go travel, what we've been thinking about for a long time, right? So the purpose really matters on if you're going for that known growth or that unknown growth, because just like the elevator, if you miss the penthouse and that's what you were dreaming of for the last 40 years, that's pretty bad, right, AAA?
Yeah. Indeed. And that is truly egregious for somebody not to have the retirement that they've always dreamed of. And how many advisors does it take to ruin somebody's retirement portfolio? Well, one. And some bad news. I heard of somebody who is not our client, who is going to be coming to one of our events recently, who fired her advisor because she'd been with him for 7 years and she did a negative 1%. That's egregious, right? 7 years down the drain. But, and when you're talking about definition of growth, Daniel, and the industry's definition of growth. I want to interject here the aspect of what they typically mean is appreciation. The account value is appreciating, or at least the share price are appreciating. They're going up. But is that truly growth? Is that something that you can use is part of the question, right? And whereas our definition of growth is more of a grassroots definition of growth, which is the idea of income plus dividends. Income and dividends plus capital appreciation, share price going up and down together lead to a known growth that will happen over time, like the escalator, which is a whole different way of looking at things. And, if you just start listening to us, you're listening to Financial Strategies with Andrew and Daniel Agemy. And today's topic is known growth versus unknown growth. And if you just joined us, we want, people don't know what people don't know. And we have a gift for you for the first 5 first-time callers at 800-725-7616. We want to give you a book called Return on Principal by our friend David Scranton and CFP and a bunch of other alphabet soup after his name. David has written a book talking about the principles within his life that he grew up with, but also the principles of investing soundly and not eating up your principal of your retirement accounts. We love to put this book in your hand for free by calling us at 800-725-7616 for your free copy. Call now, 800-725-7616 for the first 5 first-time callers for your free copy of Return on Principal. Call now. All right, Daniel. Well,
there's 2 different ways, AAA, to get your account to go up. And that's what we're talking about today. That's the analogy of the escalator versus the elevator, right? There's 2 different ways. Now, typically, people are focused on share price go up, but there's another way, and that's what we want to start focusing on. So you've mentioned it a couple times. Growth equals income plus capital appreciation. And so you can go for capital appreciation, which is stock price going up or going down,
right?
Over time. The difficulty with that is to actually get growth is you have to sell. Okay? So to actually get your growth, you have to sell because equity is not money, right? You can have equity in your house. You can have equity in a stock. It can go up, 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 but you can't spend that unless you sell it. And so timing has to be just right. It's a very difficult game to get timing right because if it goes up, your Tesla stock goes up 300, 400%, and you sell it, and then it goes up another 1,000%, you're mad. You didn't time it right. And then, right? And then it goes up another 1,000%. And you buy it and then it comes down. So the timing to actually be able to use the money for the things you want, it has to have perfect timing. Because if the market gods, as I say, don't cooperate with you, and you go into retirement and they're not cooperating and you have to sell at a loss, that will wreck your portfolio or that could wreck your portfolio. Okay, so the first way is you look at income coming into your account. What does that mean? That means dividends
Daniel,
from stock.
Let me stop you there for a minute when you're talking about that capital appreciation thing, right? And Tesla is a good thing because I've come across a couple people recently. We owned Tesla back in the day and we made money on Tesla and we got out of Tesla. Well, recently I've come across a couple people that bought Tesla when they had a big, drop in their stock. $230 a share they bought it for, and it's now worth $430 a share. So they made some nice money, right? But that is kind of by accident. They happened to be at the right place, the right time to buy that at $230, right? When we bought it, we knew it was low and it went up, and we knew it was high, and we sold it and we got out. Now it's going to have this fluctuation, so people can make money. But, one of the persons that has that stock, he has it in his play account, right? He's not depending upon it. It's the old purpose versus performance situation. He's getting his purpose taken care of, and it's in his performance account where he's having fun with it to do it. If he makes it, great. If he doesn't, it's not the end of the world to him. So this is something, and like earlier too, Daniel, I just want to say, you said which way do you want to go, the elevator or the escalator? And if you're listening to the show are more the elevator approach, well, the show is not for you. Because we're talking to those people that want the slow and steady wins the race. Actually, it's not slow and steady; it's just steady wins the race, and methodical, stress-free, that kind of thing. So that's who we're talking about specifically today. So, okay, Daniel, now that we talked about growth and appreciation, and you let me get my 2 cents in, go ahead and start the other fashion. So that's the one way, and the other way, right?
Okay, so let me say this again. So growth equals income plus capital appreciation.
Right.
So you're talking about capital appreciation.
Correct.
And the capital appreciation in your example, there's no growth unless you sell the stock. So his stock went up to $400 a share,
right,
or $50 a share, but he didn't actually make any money unless he sold
right,
it. And that's
right,
what I was saying earlier is tomorrow that might be $250 again. And then
right,
there was no growth at all. But he's going to feel real bad if he sells that.
Yeah.
And it goes up to $800 a share. So he's in a trap. This is very difficult. That's fine if you're 20 years old because it doesn't really matter in the long run. But unless it's in a play account like you're talking about, that's not a way to... Your wife will probably kill you because when you're on vacation and your retirement accounts drop by 50% because it was in Tesla,
right,
then you're canceling your vacation and going home and eating rabbit
right,
food while you wait for it to come back.
Right. And that is the idea. And the big thing, if you're depending upon capital appreciation, it's depressing, right? Because it can turn into capital depreciation. Right. And that's depressing. Like what you said, you're on vacation and it turns into capital depreciation and you drop by 50%. And you've got some problems if that's what you're dependent upon. That's why we're talking about known growth versus unknown growth. Today's topic on Financial Strategies with Andrew and Daniel Agemy. We're glad that you joined us today and hope that you're enjoying this as much as I'm enjoying this conversation. But so many times people will say, can I retire? When can I retire? How much do I need to retire? And we see all kinds of ads on the internet saying, is $1 million enough to retire on? Well, it depends. There's a lot of things it depends upon. Excuse me. Okay, one of the things it depends upon is the aspect of what your definitions are for retirement. So we have a report called the Retirement Readiness Report or Retirement Risk Report that we can put together for people to help them understand if and when they can retire and how they can retire. And if you want to have a RRR conversation, as we call it, to find out more about that, please call us at 800-725-7616, 800-725 for your free, no obligation RRR conversation to help you understand if your retirement readiness report, retirement risk report will work for you. 800-725-7616. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
Growth equals income plus capital appreciation. We talked a lot in the last segment about capital appreciation, growth definition, therefore, but what is income? I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about known growth versus unknown growth. AAA, this is a big thing that's almost embarrassing that our industry doesn't talk about very much. What is growth? Is there a difference between what is known growth and what is unknown growth? What is growth, AAA?
Value, assets, value increasing over time that's available for you when you need and want it most. And there's an account value that grows, but there's also income value that grows. And what most people need when they're in retirement is income. And if they don't need the income, that can be reinvested to create growth on the account.
So if we looked at it like a paycheck, it would be if you have a paycheck of $200,000 a year, how much of that is you're spending? How much are you keeping it? Right? And so how much of that goes away? If you stop getting your paycheck of $200,000, how long can you live? So what's the goal? To increase your paycheck and make sure your paycheck never runs out? Or is it to try to pack away that money for a rainy day, right? Well, most people, when they're actually thinking about employment, they want a bigger paycheck. They're not so concerned with saving money in their bank account so that they have a cushion. They just are thinking about, I want $200,000. Now I want $400,000. I want to make $1 million a year. Whatever those numbers are, it's different for everybody, right? But that's why you see these people who make $750,000, or people have heard of them. They lose their job and they have no money because people are more focused on the income coming into the account. Now that would be basically growth, right? That would be basically growth through reinvestment, growth of income, right? So when we look at income, or this equation, growth equals income, the first method is you're taking that income and you're saving it, and it's compounding and it's growing and it's compounding and it's growing, and it starts giving you another stream of income that you're no longer relying on. The stream is getting bigger. It's like increasing your paycheck. Whereas with the capital appreciation, you can get that on top of the growth. Now, most professional advisors and most investors flip that around and they go for capital appreciation first because it's sexy. And then you get a little bit of the income on top of that. And that's what helps the thing compound in the bad years, but it just barely does anything. It barely helps it compound in those bad years because the income is very small, right? And so if you had $100 invested and you earned, for example, $3 in dividends, you made $3. You made $3 regardless if the growth of your account went up or went down. You got $3 of growth. Now you have $103, right? That's the
assuming you reinvested it. Right. Yep. Yeah, that's good. So, you grow your money from $100 to $103, and all you did was collect the dividend. Nice. Good. So when the I represents dividends, interest, those kinds of things that come from typically contractual investments, which that's how we are able to know what you're going to make because it's a contract. As opposed to the stock market, when you're buying stocks, you don't know what you're going to make. There's no contract.
Right. People can invest in all kinds of different dividend or income producing assets, right? People use real estate. People use dividend stocks, bonds, all kinds of stuff can produce income for the account. And when you get that income, you have two options. You can reinvest it or you can spend it. But if you reinvest it, then it's growing your account organically.
Right, which is huge, which is the way people used to do things in the 50s and 60s and 70s, as opposed to the capital appreciation that kind of took over in the 80s and the 90s and to today. You're listening to Financial Strategies with Andrew and Daniel Agemy, known growth versus unknown growth. The income secret that retirees seldom learn is for you today because people don't know what people don't know. And we love to be able to educate you further on this. And in regard to all this, Financial Strategies with Andrew and Daniel Agemy is geared toward those in and close to retirement, 50 years old plus, $500,000 plus. And we have already, the stuff we're giving away is for anybody. And we have this checklist that I'd love to give you today. It's called the Retirement Readiness Checklist. And it's just a simple checklist going down, are you really ready for retirement? And use this checklist to help prepare for retirement. So income planning, do you have a written retirement income plan? Are your income sources diversified? Do you know how much monthly income that you need to or can safely withdraw or receive? And we'd love to put this in your hand for free by calling us at 800-725-7616 for your free copy of the Retirement Readiness Checklist. Ask for it by name, Retirement Readiness Checklist, 800-725-7616 for your free copy. You listen to Financial Strategies with Andrew and Daniel Agemy. Known growth versus unknown growth. So we've been talking about unknown growth is kind of like taking an elevator. Known growth is kind of like taking an escalator, knowing that you're going to get there. And it's kind of the steady arrangement for growth. And where we just finished off was talking about reinvesting the dividends and interest to create organic growth of a person's retirement nest egg.
Yeah, AAA. So that equation, right? Growth equals income plus capital appreciation. So you can look at it like this. If typically equity markets grow, let's say 7 to 8%, and then they have 1 or 2% income.
Okay.
Now that means you're going to get 1 or 2% each year. So you have $1 million portfolio. You're going to get
$10,000,
$10,000, $15,000 a year.
Yep. Right.
You might get more, you might get
fees.
less. But that's the known versus the unknown. Now, if you flip that around and you say, you know what, I want those dividends and interest. I want that cash coming in no matter what. Then you flip that around and you look to get 6 to 7%, so $60,000 to $70,000 a year of dividends and interest. That's coming in. That 60 to 70,000 is coming in. You do whatever you want with that. Most people like reinvesting, some taking. Some people just reinvest it all. But you get that coming in, and then you get your 1, 2, 3, whatever it is, percent growth on top of that. But it changes the mindset. So you know what you're going to get, known growth coming in, and you have the capability to do whatever you want with that. Why is this so difficult for people to understand? Wall Street, the industry, everybody's just talking about capital appreciation, stock go up, stock go up. And when it goes down, there's not really anything you can do about it. You can sell, or you can cover your eyes, or you can unretire, right? Like you don't have a lot of options at that point in time. So it's a mindset of price go up versus cash flow, cash coming into me no matter what, right? AAA.
Kind of like your paycheck was. Right.
Yeah. That's what's so difficult for people to get their heads wrapped around, because they're taught for so long.
Yeah.
Stock price go up. It's not even growth. It's just stock price go up.
Right.
Because if it was growth, you could look at it either one of these two ways we've been talking about.
Yep. Right. And that's where people get all whacked out. That's the secret that retirees seldom learn, because they're so used to 30, 40 years of capital, or even 50 in some cases, or more, capital appreciation mindset. It's hard for them to get their minds out of 401k brain, as we call it, into an income brain, a retirement brain, because things have to be different when you're in retirement. And, it's a different way of looking at it that lends to security, to consistency, to stresslessness. And, we find that people really like it a lot to change. It takes a lot to change because they've been doing things for so many years in a certain way, but there's a huge difference besides depending upon the share price increasing versus the income. And the thing that I want to say, Daniel, is so many times we will help somebody to change their perspective on how this happens. And then they're like, well, I want to see my accounts every day. Why do you want to see your accounts every day? Because I want to see what happens with the market and my accounts. I said, but you're not in the stock market anymore. It doesn't matter what the stock market is doing. You don't have to think about this stuff every day. You just know that on that $1 million, you're getting $50,000, $60,000 net a year. That's all you have to keep in mind. Now, the only decision you have to make is, do you want to take it all in cash every year, or do you want to reinvest some of it or all of it every year? That's the only decision you have to make. And it doesn't matter what happens with the stock market.
AAA, it goes back to the escalator and the elevator. You can get in the elevator and you can watch all the flashing lights as you go up and down and watch all those lights, or you can stand on the escalator and you can actually enjoy life. You can enjoy your views. You can enjoy the beach. You can enjoy, right? Like, there's not really much to watch with the investments because it's just slowly going up, but you get to watch everything around you compared to the stock price. It takes all your attention. The lights in the elevator flashing all ups and downs and everything like that. That's the difference.
Yeah. I like that analogy, Daniel. Especially like if it's in a department store, you're riding up the escalator, you're looking around, you're seeing all the different things that are in there or whatever. Or maybe it's in a mall where there's greenery and whatever, right? Which is nice. As opposed to the elevator, you got these closed walls, you can't see anything. And you're just trusting that the elevator is going to get you to the floor you want it to be. But your ride is not necessarily enjoyable unless you happen to be in conversation with somebody in the elevator. There's the
about
outside
all the flashing lights.
But they're all the same color and they're usually white. I mean, come on, give me some colorful lights, right? All right. Well, you listen to Financial Strategies, Andrew and Daniel Agemy. Today's topic is known growth versus unknown growth. The income secret retirees seldom learn. We want you to learn today because people don't know what people don't know. And today what we have for you is a white paper that we'd love to put in your hand, a paper that will be able to help you understand things and understand what we're talking about in a different way. It's called the Introduction to Stock Dividend Investing. Reinvesting or investing with, all right, sorry, I have a little technical difficulty for some reason, but stock dividend investing, it's a different way of looking. Reinvestment of dividends is the secret that retirees need to know and will help them to retire and stay retired. We love to put this paper in your hand for free by calling us at 800-725-7616, 800-725-7616 for your free copy of Stock Dividend Investing. Call now, no obligation.
The biggest mistake retirees make is not switching from the growth model to the income model. A good retirement plan is having enough income to last the rest of your life. Any problem in retirement, it can be solved with income. The biggest concern that retirees have is running out of money. The second biggest concern is that they want to grow their money so that they don't run out of money. And they think it's synonymous when it's not necessarily the case. People don't know what they don't know. And they're not going to know unless somebody tells them. People think that the only thing that they can do to grow their money is by investing for growth in the stock market. And it's very much a herd mentality. But you can only get growth when the market goes up. When they invest for income, they're able to get money no matter what happens. I'm Andrew Agemy, founder and CEO of Agemy Financial Strategies. We've been helping people enjoy stress-free retirement for over 30 years.
This is Financial Strategies with Andrew and Daniel Agemy.
AAA, it's kind of mind-blowing how many people come in and they will say, Daniel, Andrew, I'm talking to you guys because I asked my advisor if I could retire, and he said something about 4% every year, and it didn't make any sense to me, and it doesn't make sense. They couldn't tell me if I could retire or not. I'm Daniel Agemy.
And I'm Andrew Agemy. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is known growth versus unknown growth. So that's an example, Daniel, of where, the advisor doesn't even know what he doesn't know.
It's ambiguity. Like that's your job.
Yeah.
That's your job. Why can't you let this person know, right? How many times? It's too many to count how many times people come in and they say those things. They couldn't tell me. Well,
right.
Or we weather people now?
Or what they do, right? I think of the one client who came to us because her financial advisor said, you're going to run out of money when you're 92. That wasn't acceptable to her. And I told her that wasn't acceptable to me because in today's time frame, with DNA being what it is, it's so easy for somebody to live to be 100 years old, or at least well into their 90s. And what happens if she lives to be 93 and she ran out of money when she's 94? That's terrible, right?
Yeah. Well,
so she changed it.
We didn't really get into this today, but part of that is because of sequence of returns. And a way people can think about that is it matters when you retire. It matters when you start taking money out of your account. Because if you start taking money out and you're in 2010, markets basically have just gone up since 2010.
Right.
Whereas if you had retired in 2007, it would be totally different. Because if you take $40,000, the 4% rule, out of your account in 2007, you take $40,000 out, okay, then markets crash 50, 60%, depending what market you were in, and now you're still taking $40,000 out. You never get back. You would run out of money in that scenario, even though markets are so much higher today than they were then, because it mattered when you started taking your money out. Whereas if you did the same exact situation in 2010 and you just started taking $40,000 out, your account would be multiples higher than it was when you retired. And so that sequence of returns, or when you retire, matters so much. And so basically, when you're talking about growth equals income plus capital appreciation, if you focus on the income and the income can sustain your withdrawals or the money you need to live your retirement, then all the capital appreciation or all the extra dividends grows your account, and the sequence of return or when you retire doesn't matter anymore. It takes that out of the equation.
Right. Exactly. The key to what you're saying, I think, Daniel, is, taking money out of your account, withdrawing money from your account. That goes along with the 401k brain. Let me grow to $2 million so I can take $200,000 out for 10 years, and then I'll use up all my money. That's the inaccurate way of thinking, right? That's the savings bank way of thinking. And the savings bank, the bank is not what the bank used to be. So we have to think differently today. One of the things that and withdrawing money from the accounts is how we have to think differently. Here's the other thing. Daniel, 40 years ago, there weren't so many people in our business as today. And the reason for that was that most people 40 years ago had pensions. They didn't have retirement savings. They had pensions. So they got a check. When they retired, they got a check every month. And that's what we're proponents of, getting checks every month instead of withdrawing money. Their retirement check as opposed to their working check, right? Two different things. Right. And then as time has gone on, we transferred over into the 401k savings aspect. So people don't know how to invest their money and how to deal with their money. So that's why our industry has grown so much over the past 40 years, because the need has become greater over that period of time. Now, but this is one of the things that people within our business haven't really grown toward when it comes to retirement planning, how to turn that into an income. Now, I've been around 35 years seeing this stuff happen, and I've seen the industry go and start picking up at one point, a decade or two ago, saying, okay, we have to create income for people because they're going to retire and they're going to need this income. And they create income, but it's not in the best fashion. And being a fiduciary, I want to do what's in people's best interest. Not just what's suitable for them to do, but what's in their best interest. And that's where, when we're talking about it, taking money out is not in people's best interest, but receiving dividends is sweet. And that works real well. And I'm always giving this analogy, Daniel, and I just love the analogy. When you're in retirement, you have to eat. Now, there's two ways you can eat, what we're talking about today. One is investing in roosters. You invest in capital appreciation, growth, and you invest in roosters. Well, you have to kill roosters in order to live. And if you kill too many roosters at the wrong time, the sequence of events Daniel's talking about, you could run out of roosters. you bought chickens and you only ate the eggs, if at all, well, you'll always have a renewable resource. You'll always be able to eat because you'll always have the chickens, even if you use up all the eggs. But if you don't need all the eggs, we take the eggs, we buy more chickens. When we get more chickens, we get more eggs. When we get more eggs, you get a bigger retirement paycheck. You're listening to Financial Strategies with Andrew and Daniel Agemy. Known growth, investing in chickens versus unknown growth, investing in roosters. You don't know what's going to happen. This is the income secret that retirees seldom learn. We love to come to you today, and we're glad to be able to have you on the show today and speaking to you. And I want to provide for you, for those in our listening audience, we have a retirement readiness checklist. Helps you understand whether or not you're ready for retirement. And if you want to have a conversation to see if you're ready for retirement, we have analysis that we can put together to be able to help you with that. So if you're interested, if you're in or close to retirement, you want to make sure that you're going to be okay in retirement, please call us and we will help you analyze your situation. 800-725-7616. 800-725-7616. No obligation, free of charge. So, Daniel, I like that idea of dividends of the eggs on $1 million being $50,000, $60,000 a year of a retirement paycheck that I could use or not use. Or if it's $3 million, right, we're looking at $150 to $300,000, depending, well, not 300, but 150 to 200 plus of income that we can get out of that as well every year through retirement. That's a beautiful retirement paycheck. As you say, retirement, lifestyle chips that can be cashed in are those eggs.
Yeah, Triple A, it's a shift. The shift from hope to a knowing. And that's what I see most people who are entering retirement. They want some knowing. They want some certainty. You mentioned earlier, there's enough changes when you retire. You don't need that abstract, maybe 4%. I'm not sure. It depends how long you live. It depends on, right? Like, people are frustrated with that stuff, and that's what most people hear. It depends what markets do. It depends if you take 4% and then it dropped down to 3%, then you're okay, right? Like, that's a plan, and plans have a lot of difficulties associated with them. The plan is we're going to throw the ball all the way down to the end of the field and hope somebody catches it, right? The strategy is based on things that you know. We know, like you just said, your $1 million is going to generate $50,000, $60,000, $70,000 a year income.
Right.
That's what you know. Now you can make plans, vacation plans, graduation plans, education plans, hobby plans, because you know what you have to spend. And that's the strategy, so that you can have a strategy to do all your plans.
Right. It's a wonderful thing to have the peace of mind that knowing what's going to happen as opposed to not knowing. The unknown is a scary thing. And that's what we're trying to just, bring across to you and our listening audience today is you can know if you can retire. You can know how much you need in retirement. You can know how you're going to get to there and what you're going to do. And we would love to be able to help you look at that and figure that out. We have what's called the RRR, Retirement Readiness Report, that says whether, or we can also call it the Retirement Risk Report if you're in retirement, that will help you understand if you're ready for retirement, if you're what you need to retire, when you can retire, how you can retire, and you can know and have certainty about that. Because if you want your retirement to be stress-free, invest for the I more than the G. And we love to give you this opportunity for this RRR, ask for it by name, RRR conversation by calling us at 800-725-7616 for your free, no obligation retirement readiness report conversation. 800-725-7616. If we believe that an educated retiree is a happy and stress-free retiree. And so you've been listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic has been known growth versus unknown growth. We appreciate your listening ear, and we look forward to educating you more next time. Until then, peace.